Okay, hello everybody. My name is Lita Abella. Welcome to my new show on YouTube. I'm changing the format up a little bit, so this one's going to be a different format. But first, let me tell you a little bit about myself. I'm an entrepreneur, health and wellness consultant, public speaker, licensed private investigator, and former LAPD lieutenant. And in between all that, I went to law school and obtained my JD. And I tell stories that inform, inspire, and influence others. So today, what I'm going to be providing are tips in the real estate market, because I know so many of us have so many questions about this market, especially right now during COVID. And I have two special guests to help provide that information. So I would like to introduce Silvia and Ami Singh. So Silvia, would you please first start and just give us a little bit of background information on yourself, what you do, a little bit about your personal history.
Sure, and thank you, Lita, for having us on your show.
Thank you.
My name is Silvia Portugal-Singh. I am a third-generation real estate broker and investor. I have a background in technology, and we have a brokerage and development firm that it's our passion. We buy and sell for ourselves, for our clients, and we're excited to share the update with you guys among everything that's going on.
Wow, that's awesome. Ami, how about yourself?
Thank you for having us on as well. I'm a business partner with Silvia as a broker, and before that, I've got about a decade of construction development experience, so we still operate that other half of the business, and we help clients out on looking at how they can remodel their home as well, or finding that perfect home, what changes need to happen. So we do it all from start to finish.
And it just so happens that you two are probably the most good-looking couple I've ever seen. Husband and wife. How long have you guys been married?
She is, I'm not.
We've been together for 10 years and married for going on 6 years now.
Wow, that's great. It's great to see two professionals that are able to work together in this industry and have a thriving, successful business. So let's go ahead and get into all this information that we're so excited to learn about. So tell us what is happening in this real estate market.
So we want to preface that this is an accumulation of several different sources: California Association of Realtors, National Association of Realtors, Stephen Thomas, one of the economists that we've been lucky enough to be on regular calls with, his housing debrief, and a few others. So before we get started, thank you for that information, all those various sources.
So the question in everyone's mind, what are consumers doing? Should they be buying? So what we see on the slide here is a great piece of information. Since January, 31% increase in how Californians feel about buying their home. And most particularly from March to May, we see an increase. That's a really good sign because we're coming out of this COVID thing with buyers wanting to now purchase.
And one of the big reasons for that, that increase in demand is because supply is so low. There's very little inventory. There's very few homes that are available. Actually, the last time that the supply was this low was May 2013. So that's, yeah. May 2013 was the last time our inventory levels were this low.
That's amazing.
I know, yeah.
So with that in mind, a lot of people are wondering, when's our economy going to recover? Now, we don't obviously have the magic answer. We'd be on a yacht in the Pacific somewhere. But we have a lot of good indicators from a really great group of economists and financial professionals. So we've been hearing about the news, it's going to be a V-shaped recovery. But since the job claims numbers have come out, they've done a slight correction to that, and now what they call is a J-shaped recovery. Good news is, it's a recovery. We're going to come out of this going upward. The difference is with a J-shaped recovery, there's growth, then a moderate leveling off, and then a greater increase in the GDP. And that's what we're looking at here on the GDP versus time spectrum. So big picture, things are going to be okay, but it's not just going to be a direct linear path of growth.
And one of the biggest differences from this V shape that everybody was projecting, that changed just from last week when the stay-at-home order was extended and now it's being phased. So that's why you're seeing more of a J instead of the V that was projected. So if everybody was allowed to go back to work and everything was going to be, May 15th, like it was projected as of just a week ago, we would have seen more of a V, but the fear of that was having the W, which is everybody goes back, that's the V, and then we have a huge outbreak again. We're back down to where we started. So they're doing this now in a phased approach, which gives us the J model. And just to one more, going a little deeper into this, the housing market is different than other industries. So this isn't necessarily indicative of retail, for example, or even hospitality, you know, hotels and such, right? Housing is unique, and we'll kind of go into why that is.
Okay.
Looking next, how is this different than 2008?
That was a big question that I was going to ask, because everyone's been comparing this to the Great Depression of 2008 and those years following. So how does it differ?
So one of the biggest things, let's look at home prices changing. Back in 2008, again, these are California averages, is that we saw upwards of a 19.7% decrease in home prices. And prior to that, the dot-com Gulf War crash in 91 saw about 1.9% decrease. So what are two takeaways here? One is financially driven, the other one is more of a natural event. So when we see a natural event like war, or in this case, a pandemic, then we see, yes, prices come down slightly, but not drastically. Whereas in a financially driven event like in 2008, that caused it to come down greatly, 19%. Some other things that are leading up to that that also make us as real estate professionals and economists feel better about what's going on in this economy are the years leading up to those recessions. Leading up to 2008, we saw home prices escalate upwards of 12%. While it seemed great at the time, no one knew what that meant for the overall economy. A good economy is a stable, slowly growing economy, not one of quick accelerations like we saw prior to 2008. When we look at the past 6 years, we see a much better picture, averaging between 4 and 6% appreciation of home values, which gives us a much better feel for the economy. I think Silvia will touch a little more on this as well.
Yeah, so the biggest difference is that is not this. So that was a financial crisis. This is a pandemic, more of a natural disaster. So it affects our economy differently. While unemployment rates are higher than the Great Depression, which is so unfortunate, the rest of the economy is still doing well. While the stock market is really hurting, like we're seeing here, housing has is special. And one of the reasons why is this low mortgage environment that we're in is part of what is instigating this demand. People are seeing the savings. I mean, on a $500,000 home, because of the interest rates where they are, that's a $30,000 savings over 5 years. So while unemployment is down and the two main sectors that are being affected are retail and hospitality, people aren't going out. They're not spending money on going shopping, like we were talking about how we haven't been shopping for 3 months. Saving that money, they're not going out to the bars and to the restaurants. So they're kind of looking more long term. What's the smartest investment for me and my family? I'm spending a lot more time at home. I'm going to be working from home, which will probably continue in a lot of industries. So they're people are reprioritizing where they're spending. But we have a chart to go into what the savings breakdown is per price point, and it's really shocking. So,
and there's great information Silvia gave. We see that in these numbers here. So with the S&P 500, that's the stock market, aggregate the top 500 performing stocks. So to Silvia's point, without people going out and spending at retail, restaurants, and so forth, those stocks are impacted by that. And so we see here in 2001 and 2008, corrections of upwards of 45 to 50% decreases in the S&P 500 stock market values. But the good thing is, to Silvia's point, people saving money, with people looking for some more solid investments like housing. We see that during the dot-com crash, about an 7-8% increase in home price appreciation, further showing that there's a separation between stock market and home values. 2008, financially driven, so it did affect home values slightly, anywhere from 4 to 10% at the peak. But again, not what we're dealing with here. We're dealing with a natural pandemic, so we're not going to see those type of impacts. And we'll show later the data that supports that. They actually increase. So a lot of people hear the term months of inventory. What does this mean? So 2007, 2008, there's an 8.2 months of inventory versus today, 3.1 months of inventory. That means if everyone today went out and bought a home in Southern California, we would literally be out of housing in 3.1 months. And then we'd have a huge problem because people always have to buy and sell. People have to have a roof over their heads. So that's what home builders and investors track to make sure they're putting out the right number of houses to keep up with supply and demand. It was different in 2007, 2008, where they were basically handing out free money to the builders, to the investors, and they were putting out way too many homes. We remember all the construction equipment, the cranes, building everywhere. We all saw it and thought it was great, but there weren't that many people that needed all those houses. Today, it's a different picture. With the low amount of inventory, it's keeping prices strong. We're not going to see those huge dips in reduction of prices because, frankly, there's not enough inventory for the amount of people who are wanting to buy.
And all this information is strictly for California or national?
Averages in California.
Because we're different anyway when it comes to just about
We are.
California.
Okay.
Yeah.
And then these numbers, this is how we can define, is this a seller's market? Is it a buyer's market? Is it a balanced market? So what these numbers are telling us about 3.1 months, as of today, the average days on market is 91 days in LA County, to get even more specific. And the definition of a slight seller's market is anywhere between 60 and 90 days on market, and a balanced market is 90 days to 120 days on market. So we are teetering on a slight seller's market because of low inventory and a balanced market. So when we're in a balanced market, that's an opportunity for both parties, buyer and seller, to optimize their investment. So these numbers are supporting that we are now more in a balanced market slash slight seller's market because of lack of inventory.
And we're seeing that with our personal clients. We've, even throughout this Corona pandemic, have had people buy and sell with us, recently list just last week, 2 more properties with us. So it is real. Looking at average home prices. So this is a great chart going all the way back to January 2005. The main takeaway here is average home prices staying above 600,000. Even better year over year, and this is as of data this just past week, we see a 0.6% increase on year over year home values. We see a slight dip from last month of just 1%, which isn't surprising given that there have been a large number of losses and there have been concerns. But a lot of that's driven by people's fear of not knowing the facts. And that's one of our goals today, is to make sure everyone knows real facts of what's going on. So that's what this number is showing here.
And the projections for the end of 2020 is that home prices will appreciate 3%. So while that's down a couple percentage points, it's still very, very strong year to year.
It's all about appreciation.
When you say average, is the average home like a 3-bedroom, 2-bath, 1,500 square foot home? What's an average home?
So the average price is around 600,000. And again, this is for California as a whole. Of course, different areas, they're going to be, you know, in Pasadena, for example, the nicest part of Pasadena, it's a 2-bedroom for 900,000. Whereas you go to, you know, Riverside, and you can get a gorgeous home that's 5-bedroom plus newer construction for that. So it depends on the area, but across the board, the average is 600,000.
Okay.
Yeah.
And then here we drill into a little more of the details. This is a weekly look, and this is also very promising. So we do see the average cost and number of sales defined on the left and right. While it's not drastic, and nor should it be, that's actually good for the economy, we do see an uptick in the average dollar per square foot just this last week. So that's actually really promising, as well as the number of sales. We hear all the time when we speak to our clients, oh, you know, we want to sell, but nobody knows going to be out there to buy. It's contrary. It's a feeling, and naturally people should feel that way just out of their fear, but we're here to clear up that fear. The numbers here in LA County show there's been an increase in closings, which is great.
And the reason for that, that's fueled by the low mortgage rates. That's why they're keeping these at historic lows. They've never been this low, ever. And that's what's causing this quick recovery. people are taking advantage of the market because of the savings associated with those low interest rates, which we'll show in a couple slides.
Okay, that was going to be my next question. What are the interest rates? But you're going to show it. Okay.
Yes, I am.
Real quick, we'll touch on jobs, the good, bad, and the ugly. Yes, it is sad that millions of people have lost their jobs, but let's look at what that slice pie is. So the majority of these jobs, almost 60%, are in the food services, and it's your servers, your bartenders, it's your day-to-day workers at front desk on the front line. And while they're so vital to the economy, as home buyers and sellers, we have to look at who is buying the houses. And that's where that 9.8% others. That's pretty much your W-2 employees who have steady paychecks of annual salaries. They're qualified to have large savings to be able to put down a down payment on a home. These buyers that are in other segments of the economy, the trades of retail and childcare workers, healthcare, construction, food service, and so on, they also need a place to live. This does present an opportunity for our sellers, whether or not they want to sell their home or if they want to rent their home and purchase and rent their home to these people. Because all these people still need a home, and many of them have families and they want to live in a home and have a backyard. So we're helping our clients with that as well. And we'll talk about that next.
Yeah, and this again, it goes back to the areas where we have this very unfortunate unemployment rates that have increased. These are where U.S. consumers are spending all their money. Nobody consumes like Americans. We live to buy, we live to spend money. That's what we've always done. But this shows us that 60%, this is where people have been spending all their money, and instead of spending it, they're saving it. And they're reinvesting it in their homes. It's now their workplace. It's, there's growing families. I mean, there's so many different things that are going to come out of this, the Zoomer generation, right? All these kids that are going to be born, but they're reinvesting in their homes and in their futures. So while the unemployment rate is rising for these industries, the rest of the people that aren't in these industries are saving that money that they would be spending going out.
And this unemployment isn't forever. So this is the other good news here.
Yes.
So what we're looking at is currently about 15% unemployment rate, but our good friends at Goldman Sachs, who are very reliable, are projecting, fortunately, a decrease in unemployment. And ultimately our goal is to get around 3 to 4% unemployment. That's very healthy. And this is a good projection showing that it will be a gradual decrease, but a decrease. So it's showing over the next 3 years.
I was going to mention, Ami, if you could come a little bit closer to the computer.
Oh, sorry.
Okay.
Yeah. So the other question everyone asks is, well, how is this going to impact our ability on home sales to buy or sell? So it's a big misconception. Just when unemployment rates rise, home sales drop. There's no correlation there. And these are actual numbers that show since 1989, you can see even during the decreases in unemployment, you can see an increase in home sales by this chart. That's very important for our viewers to understand.
So this is this line here is the unemployment rates.
That's correct.
And then this represents housing. So housing stays consistent. People have to have a place to live. And what is also the biggest factor, again, supporting this is this low mortgage environment that is the reason for the rapid growth.
We're looking at next. This is a great slide.
And recovery. So this is the slide we've mentioned a few times here. The low mortgage rate environment is a gift. So at 500,000, where's my little laser? Here we go. At 500,000, when our interest rates back in 2018 were at 5%, you're looking at 2,684. This is just for interest. Okay, so you're in the red. This is how much you're spending. Now with current rates at 3.25 and actually even a little lower today, we put these slides together yesterday.
That's how fast things are changing.
It's even lower today, but let's say yesterday at 3.25, which is just the lowest that we've ever seen, historic lows. Your monthly savings, $500. If you accumulate that per year, that's $6,000, almost $6,100 in savings, just interest alone. Not even factoring in sellers that may be motivated and cost savings associated with purchasing under market. But in 5 years from a $500,000 home, you're saving $30,000, $30,480. So this is what buyers are are realizing, and that's why the demand is so high right now. I mean, it's up again 7% based on this last call we had with Stephen Thomas, economist. That's from 2 weeks ago. So the demand is very, very high because buyers want to realize these savings because these interest rates won't last forever.
When you're saying a 3.25 interest rate, are you referring to a 30-year fixed conventional?
Yes, that's what these are taken from. And we can dive deeper into that. We just wanted to put kind of a for instance. So
that's typically the standard that you'll find in the news is a 30-year fix is most common type of loan that they'll reference metrics for, but there are many different loan programs, which brings us to our next point. Everyone's wondering, what should I do? So step one is things are a little different since back in January, February, where you could go to open house, see an open house, be interested in it, then figure out if you go and qualify for a loan. Today's sellers, the expectation is that you're already coming with a pre-approval letter from your lender. It gives the sellers comfort knowing that you're a serious buyer because they're about to open their house to you and they want you to be safe and they want to be safe. So we want to limit the amount of interaction between buyers and sellers. And that's number one, is you have to have that pre-approval lender.
yeah, the open house days of, I mean, we even used to do it. We still do on our days off. We go open house hunting and check out improvements and, you know, furniture, whatever. Those days are gone. Everything is much stricter now. So even if you're just curious, it's important to talk to a lender, and we're happy to give referrals, or if people, you know, start with your bank, wherever you bank, Chase, Bank of America, etc. And just get an understanding of what can I qualify for. It doesn't cost you anything, and so many people are so surprised by what they learn. But even to see a home, let's say you see a home online and you're like, oh, I have to get in to see this, you are going to be required to have this pre-approval. So it's good to have it. It's a free
15 to 20 minutes.
15, 20 minutes. So that would be the first step of what we would recommend.
And we recommend everybody out there talk to their lender because there are programs for first-time home buyers. You don't necessarily need 20% down, which is a big hurdle that a lot of people think they need. Yeah. VA, all of our wonderful veterans out there, thank you for serving, and we have great programs to help you guys.
0% down.
It's incredible. So believe it or not, if you're not sure if you can qualify, first have that conversation because you'd be surprised how many programs are out there. So what to do next? Next, you got to determine if you're going to rent or sell your home because you have to go somewhere. And so we can help you with that conversation. Schedule a call with us. We'll love to talk you through those next steps because ultimately, maybe it is where you rent out your home you're now in to better qualify for a better loan to be able to purchase your next home. So we can talk the ins and outs of that. And then finally, make an offer. That's the most exciting part to getting everything moving and helping the economy recover as well. So thank you very much for your time, and we look forward to answering any questions after this.
Any questions?
So, okay, there was so much information there. Can you go back to, in the olden days, because I used to like to go and look at houses. I mean, I was one of those people who I would go in all the model homes and take pictures because I love photography. I love looking at how homes are decorated, and even multi-million-dollar homes that I couldn't even afford, I would go into because that's something I like to do. Can you explain to me now what the rules are as far as going into people's homes, and would I still be able to do something like that? Or are people still able to do something like that?
Yeah, so as of right now, no, we cannot. It has to be, there can only be 2 other people plus a representative. So 3 people total in the home at a time. And on every home, there should be a posting that states that that hands need to be washed, sanitized, face masks. If there's gloves, even if there's gloves, those have to be sanitized. So it's a very controlled environment right now. Now that may loosen a bit, but the days of big grand open houses, we used to call them open house events, where we'd have food and snacks and drinks sometimes, those days are gone. Will they ever come back? We hope so, but not until everything is 100% contained, because it's too much liability on the sellers, on the buyers. It's not safe. So as of right now, only 2 to 3 people allowed in the home at a time. If there's a larger family, and we've been doing this as well, we take 1 person or 2 people in at a time.
Is that regulated by county? Is that like a county of LA rule, or is this across the state of California?
Great question. Department of Health, they are one organization that are requiring the mandate on the door and all these concerns. OSHA, the governor's office, all this is regulated by the state, city, and federal government.
And local governments will take precedence. So let's say, for example, I believe I just heard that Ventura is now loosening theirs. They were one of the strictest. So local government will take precedent, but as of right now, LA County, these are the mandates that we have to follow, or you're fined. Some people have gotten even missed.
It's about safety for them. And ultimately, though, this presents an opportunity. So what we're doing for our clients is we're doing virtual open houses. And so we can send out links separately when people contact to show examples from the virtual open houses we've done. So it is still possible to see the inside of a house before you write that offer.
Okay.
So yeah.
Do you have a slide that has your contact information so that people who are watching this?
There you go.
Oh, okay. Because I was going to say, who do they contact? What's your phone number? What's your email? Okay, you have it right there.
Yes.
And that was going to be my next question is your specialty only in LA County, or do you serve all of Southern California? What's your parameter as far as geography?
So we service LA County, San Bernardino County, Riverside County, and Orange County. Being third generation, we have about 10 family members as well that live in all different areas. So we try to be present as much as we can for every showing because we love our clients. But we also have a larger team of family members and other teammates in all different areas that specialize in different areas.
And then even further, our network through Berkshire Hathaway, our parent company, gives us literally global access. We've had clients move to Europe. We've had clients move to Asia. We recently, even here in the US, clients moved to Seattle. So then we have our partners in other states, cities, and countries that we can connect them with to make the deal a seamless process and not just say, oh, sell your home, see you later, good luck in some other place. We've got them covered all the way through.
I guess we would specialize in LA County, but we go everywhere.
And I know you both are, licensed with the Bureau of Real Estate, but do you have any connections networking with like mortgage lenders and so forth? Because there are a lot of people who don't have a perfect, 850 score. Maybe they might have a bankruptcy, or especially right now with being laid off and people losing their jobs, but yet they still want to purchase a home. Do you have people that you can refer potential buyers to that will work with them with those issues?
Thank you for bringing that up, and that's a great point. Yes, we do. My mother is a lender for 40 years. We have a handful of lenders that we work with for our own loans. We have lenders that we work with for credit repair, Spanish speaking, ones that specialize in VA specific, or ones that will need to get very creative with multiple parties, for example. So yes, we have a suite of lenders that we refer to our clients that can help with any of those scenarios.
Wow, that's wonderful, because I think a lot of people are scared when they hear something like this, and okay, 600,000, that's a lot of money to a lot of people. To some people, it could be a drop in the bucket, but for the normal person like me, that appears to be a lot of money. But then you have the people who are like, oh, there's no way I would never qualify, so I don't even want to make that first step. But basically what you're saying is there are so many different programs out there. There's so many different circumstances and situations that it doesn't hurt to just, you call and find out. That's not going to cost you anything.
It costs you nothing. And let's say somebody calls in and they say, oh, I'm almost there, but I need a couple thousand more in savings. They can put you on the right plan, the right path, and it's free. Yeah. I mean, a lot of people think, oh, I can't afford it. And then they finally call a lender and they're like, oh my gosh, I could be paying less than I'm paying in rent and own my own home. I had no idea. So it doesn't hurt. It's free, and it's between you and the lender. You ask any questions you want. You can ask us any questions. It's a free service to find out what you qualify for. It doesn't hurt.
And that's one great thing about our country is that they want people living and owning homes. And so with that mindset, our government makes it possible for all these companies to find ways to help the general public find a home and move into a home. So that's nice knowing that peace of mind that people are for you for this.
Right. And that's the American dream. I mean, to become a homeowner and have that sense of security. And there's so many examples right now where there are people who are like, oh my God, I can't pay the rent. They're going to evict me and blah, blah, blah. At least when you're a homeowner, you have more control over where you're at and the situation. And it's a lot more, there are a lot more things that you can do to save the house and stay in the house for a longer piece of time. Yeah. And a home is a person's castle. That's right. Something where you're a homeowner, it's like, look, nobody can touch this. This is your kingdom here that you've worked so hard for. And I'm so excited that you're able to bring this information out, because I know so many people who, you know, want to be homeowners, but they just don't know what the first step to take is. So this is extremely valuable and important information to get out to people, especially during the situation and challenging times we're in right now. Any Absolutely. Last minute or last words before we close off?
Yeah, you know, I just wanted, what you're saying right now is so right on. You know, whether you're renting or you own, you're still paying a mortgage. You're just paying someone else's. So why not go for it and just make the call? It doesn't cost you anything, and you might surprise yourself. So, but for us, thank you, Lita, for letting us come on and share what we've been learning and what we're seeing in the market. And we're here to help any way we can.
Thank you so much. This was excellent and valuable information that I'm sure our viewers and listeners would definitely take and want to know about. So I'm going to go ahead and thank you for joining me, and always make sure that you please subscribe to the YouTube channel, like this video, and let me know what other subject matters you would like to hear more information about. And until next week, when we have another episode, I hope everyone will stay home, stay safe, stay healthy, and stay positive. Thank you so much. Bye.
Thank you.
Bye.